Welcome to this explainer. Today we're unpacking an absolutely massive, urgent shift that is happening right now in modern banking. We are going to look at how the role of the product owner is fundamentally transforming. We're talking about moving away from just being tactical feature shippers to evolving into strategic governance stewards. Look, if you're building fintech products today, the rules of the game have completely changed, and we're going to break down exactly why and how.
Okay, let's dive right into this with a totally staggering reality. Just look at this number, 99.8%. In key markets, take India for example, 99.8% of transaction volume is now completely digitized. We're essentially operating in a fully digitized transactional environment. And what this means is that there is a very loud ticking clock for legacy banks. They are staring down incredibly tight, often 12-month compliance deadlines to replace decades-old COBOL-backed ledger systems. The pressure here is absolutely immense.
And this right here brilliantly illustrates the massive legacy complexity tax that traditional banks are dealing with. Incumbents are bleeding roughly £150 per customer just to maintain their bloated legacy tech estates. Meanwhile, you've got agile neobanks operating at an incredibly lean £20 per customer. For years, traditional banks could get away with just throwing money at this problem. But in a world of 99% digitized transactions, that £150 complexity tax is literally no longer a sustainable economic reality. So here is our agenda for today. We'll be covering the legacy complexity tax, the democratization of speed, the shadow roadmap risk, POs as governance stewards, implementing design-led compliance, and finally, redefining fintech success metrics. Let's jump into Section 1, the legacy complexity tax, escaping the £150 burden. Now, the economic mandate forcing traditional banks to desperately rethink their 40-year-old mainframe systems really comes into focus when you examine the broader market. Interestingly, look at where the real revenue threat is coming from. Tech entrants, like Apple, are already hoovering up interchange fees, and those fees make up about 30% of retail banking revenues. Startups and tech giants are capturing market share from literally every aspect of the banking value chain. So banks are really feeling the pinch. Their revenues are under threat, their legacy systems are incredibly rigid, and they are basically being forced to find a way to innovate rapidly just to survive.
Which brings us to Section 2, the democratization of speed, bypassing legacy bottlenecks.
So how do product teams fight back against these encroaching tech giants? We'll take a look at this stark contrast. Traditional incumbents used to aim for one release a quarter, and now, maybe they manage one release a month. But neobanks? They're doing this tens of times a day. How? Through the democratization of speed, by utilizing things like AI orchestration, low-code tools, and what a lot of folks are now calling vibe coding. Product owners can rapidly prototype proofs of concept. They can basically bypass traditional legacy infrastructure bottlenecks entirely. It is an incredible capability, but as we're about to see, it comes with a major catch.
Let's look at that catch in Section 3, the shadow roadmap risk, the danger of unchecked speed.
You see, this massive shift in velocity builds a huge hidden danger when you have speed without guardrails. This quote right here is a cautionary tale that perfectly highlights the risk. A product manager at a scaling neobank shipped a brilliant, frictionless, one-click savings feature, and it was a massive hit. It increased user opt-ins by 37%. From a traditional tech PM perspective, that is a huge win, right? But it was rolled back entirely just 2 weeks later because it triggered an absolute internal audit nightmare. So why the rollback? Well, because that one-click feature was flagged by internal audit as a potential UDAAP violation. That stands for unfair, deceptive, or abusive acts or practices. The feature entirely lacked essential audit trail completeness. The PM built for user delight and speed, but they didn't consult compliance pre-launch. It just goes to show that skipping regulatory checks for the sake of rapid deployment doesn't just create technical debt, it creates systemic business-ending risk. Moving to Section 4. PAOs as governance stewards, a new mandate. This whole reality forces a massive evolution in the fintech industry. The product owner must now act as a governance steward. Seriously, the days of simply doing backlog grooming are over. Traditional tech PMs optimize purely for engagement, things like Agile velocity, daily active users, and net promoter scores. But in modern fintech, the PM must optimize for structural survivability and failure containment. The PM is now the essential translator. You have to bridge that massive gap between the legal department's mandate for absolutely zero regulatory exposure and the engineering department's desperate need for speed. Section 5. Implementing design-led compliance, co-creating with risk. So if we want to actually survive this new environment, we have to change how we build. To successfully implement design-led compliance, you really need to follow these 3 sequential steps. First, you have to co-create with your risk and compliance teams from day one, not as an afterthought. Second, you have to deeply understand and identify your exact compliance costs. And third, you must embed adaptive controls directly into your low-code or AI layer. You literally have to build traceability right into the product's DNA.
Let's zoom in on step 2 for a second. You cannot just build a slick feature and assume you'll add compliance later. Just look at this metric. Mandatory Know Your Customer, or KYC, compliance costs between $5 and $25 per customer. If your customer acquisition cost on a spreadsheet is $40, but you aren't factoring in a 30 to 60% failure rate in your KYC onboarding funnel, plus that $25 hard cost, well, your unit economics are completely broken. You have to design the product with these hard realities built into the baseline from the jump.
All right, final section, redefining fintech success metrics, the new laws of gravity. Ultimately, because the role has changed, how we measure success absolutely must change too. The era of tracking basic app downloads and daily active users to impress leadership is officially over. In a highly regulated, digitized environment, your budget allocation now relies entirely on a totally different set of numbers. Nobody cares about your sprint velocity if your features trigger regulatory reporting events. You are now judged on exception rate reduction, payout latency, integration defect rates, and audit pass rates. Here are the specific hard metrics that you as a governance steward need to own now. You need to reduce false positives in fraud detection because, frankly, that is a massive operational bottleneck. You must increase the auditability of every single transaction. In embedded finance, you have to maintain 99.99% partner uptime to avoid regulatory triggers. And you've got to optimize your anti-money laundering alert to conversion rates. Regulators expect to see these exact metrics in your paper trail. They demand a product owner who fluently speaks the language of risk. I want to leave you with this one final provocative thought to really chew on as you examine your own roadmaps after this explainer. Look at your current backlog, look at your KPIs, and ask yourself, are you optimizing for speed or are you optimizing for survivability? Because in the modern banking environment, if you only solve for the first, you will inevitably fail at the second. Thank you so much for joining me for this deep dive. Now take these insights and go build something that lasts.